Hello, YouTube. Welcome back to my YouTube channel. It's me, Vana Jerebeck, Seattle Realtor here in Washington. And today I'm joined by Jake Lambro with Caliber Home Loans. Jake is a first-time home buyer specialist and a down payment assistance specialist. So I asked him to come on here and just talk about how to get prepared for a home loan, because we know that if you have no experience in real estate or you don't really know where you want to start, but you do want to buy a home eventually, where do you start? So we're here with Jake. Going to talk about what a home loan is, how to get started, how to prepare, and how to become financially responsible so that lenders will want to lend to you. So welcome on, Jake. We're so excited to have you here.
Awesome. Yeah, thanks for having me. Happy to be here.
Yeah, absolutely. So let's just start off really basic. Can you just explain to us what a mortgage is and why it's important?
Yeah, so a mortgage is your loan to buy a house. Most everyone doesn't have enough money to just give the cash to a seller to be able to purchase a home. So basically, a mortgage is giving you the extra money that you don't have to purchase a home to help you purchase that home.
Mm-hmm. And a big myths around down payments. What are the basic requirements? So let's say we're starting with, how much do I need to save to buy a house?
Yeah, so we have a lot of different down payment options. If you put 20% down, that's what a lot of people tell you to do. Don't necessarily have to do that. For a first-time home buyer, you can put as low as 3% down. We actually even have some specific programs to Caliber that offer 1% down and 0% down for those who qualify.
That's awesome. Great. Love
Yeah.
to dive into that deeper. So we know that there are tons of factors that go into buying a house and getting financially able to buy a house. We've got credit and debt to income and all of these things. So what are the major factors that people who are preparing to buy a house, what are the major factors that we need to be watching?
Yeah, you hit it right on the head. Biggest one is credit. So your credit score is basically your ability to borrow. How the credit bureaus figure out what your ability to borrow is based on what you're already currently borrowing. So if you're wanting to be a first-time home buyer and you don't have any loans out or any credit out, then you're not going to have a credit score whatsoever. So step one would be to definitely get a credit card if you don't already have student loans or a car loan or anything like that.
Perfect. So credit's really important. What is a good score to shoot for?
Yeah, so to qualify for a loan, you need anything above 620. Anything over 700 is where we start seeing better rates. But if you're mainly looking to just get into a home as quickly as possible, you want to shoot for that 620 range.
Okay, so minimum 620.
Correct, yeah.
And then past 680 above is where you start to see great rates.
Yeah, we have different tiers. So from 680 to 700, we see certain rates. From 700 to 710, from 710, 720, and so forth. So anything over 740 is where you see the best rates for mortgage.
Gotcha. So the better your credit score, the better rate you're going to get.
Exactly.
And then what are the different types of credit that show up on your credit report?
Yeah, so different credits would be credit card. So if you open up a couple different credit cards, those will show. Student loans will definitely show. Even when there is forgiveness right now to not have to pay them, we still have to use a payment. We use 0.5% of the overall amount that shows. So if you have a $9,000 student loan, I think it's like $50 is your monthly payment that we have to put in there, even though you're not paying anything currently. And then the other one would be a car loan or any other sort of loan that you have, whether that's a boat loan or a personal loan or business loan, any type of loan, any type of credit card is mainly what would be showing.
Okay, so the main credit lines are credit cards and types of loans.
Correct.
Okay, and how many lines of credit should someone have to be looking good on their application?
Yeah, so usually we like to see 3. And the reason I say 3 is because a lot of programs get accessible when you have 3 plus. So that 1% down program I was talking about earlier, you have to at least have 3 lines of credit open for the last 12 months. So that would look something like a student loan and 2 credit cards. So 3 might seem daunting, but in all reality, it's not that daunting. So, if you don't have student loans, you don't have a car payment, even just 3 credit cards where you're doing limited spending on them, but paying them off every month, that would help build your credit and allow you to access some of those. Oops, one sec, sorry.
Yeah,
Sorry
no
about
worries.
that. Be able to access some of those programs.
And you mentioned a limited amount on the credit card. If I get a credit card, like if I go and get my first credit card, what should I do? What are the best practices?
Yeah, so I'm not a credit expert, but from the credit experts I've worked with, what they've told me is you want to utilize up to 30% of your maximum and pay it off every month. So if your credit card max is $10,000, don't spend more than $3,000 per month on that card and pay it off on time. That shows the credit bureaus that you are responsible, that you're not overspending what you're worth. And that will allow you to build your credit slowly.
Awesome. Yeah. And you mentioned that 3 credit lines is good. If I have 3 credit cards and my friend has a loan and 2 credit cards, is there a difference between us having a better credit or being more lendable?
Not necessarily. As long as you show that you can pay off every month and be responsible with the credit that you're being given. Like I said, not going above that 30% threshold, paying it off every single month on time. You guys would, between those 2 scenarios, you should be able to build your credit pretty consistently in both of them, pretty equally.
Yeah. And I hear you saying in every single credit line, the key is being on time. Right.
Correct.
And that
Absolutely.
is what's going to build and maintain your credit score over time.
Exactly.
Perfect. So yeah, that's the laydown on credit. What other factors do we have when we're looking at buying a house?
Yeah, so income, job history, right? So we like to see 2 years on the job of consistent income. So some people come to us and have worked odd jobs over the last 2 years. We can't necessarily use that. People have worked jobs that they don't pay taxes on. So, selling things on eBay, things of that nature, can't use that. Some 2 years of consistent employment history with pay stubs. That, or if you've been in college, so let's say you've been in UW the last 4 years and then you have an offer letter with Amazon, we can use that as well. So we don't necessarily need employment history as long as you have an offer letter showing a certain salary that you're going to be getting once you're out of college.
That's really interesting. And I think that can benefit a lot of people. So as long as you went to college, you have that history and you have a offer letter from an employer, then you can use that to qualify for a home loan.
Yeah, you can totally skip out on the 2 years employment history. Basically, we just look at college as 2 years employment history. And then the offer letter is a promise from that employer that that's what you're going to be getting paid. If you're going to an hourly job or a self-employment job, we can't necessarily do that. We're going to need to see some history. But since a salary is a promised amount of money, we can use it.
Interesting. Well, that's awesome that you can even do that. I know a lot of people probably don't know that.
Yeah, no, it saves a ton of time to know that. I know a lot of people get out of college, get their salary job, and then wait 2 years after that when they could have really skipped wasting that 2 years.
Awesome. Great. So we've got our credit, we've got our employment, debt to income. Can you talk a little bit about that?
Yeah, so debt to income ratio is a ratio that we use where basically your debts cannot exceed 50% of your income. So we take your income. So let's say you're making $5,000 a month. Let's say you have $1,000 in debts. So 5,000 minus 1,000, that means $4,000 is your buying power. Your debt to income ratio can't be more than 50%. So we divide that number by 2, and that's how much house you can afford. So that would be $2,000 per month.
That's really easy to think about. Is that all in, or is that just on the mortgage?
So that's all in mortgage wise. So it's principal and interest. It needs to be your insurance, your taxes, and anything that is going to be a cost of the house.
Okay. So can you go ahead.
Oh, I was just going to say one other interesting part of it is once you figure out what that calculation is right now, if you multiply that number by 170, I know it seems like a total arbitrary number, but if you multiply it by 170, that shows how much house you can afford in a dollar amount.
Really? I didn't even know that.
Yeah.
I'm going to write that down. So if you do this equation where you take your income, you subtract your debt, and then you cut it in half.
Cut
And
it in
then
half.
you said you multiply by 170.
Yep, and that's how much house you can afford.
Well, that's pretty easy. That's a
Yep,
good way
and
for people to kind of get an estimate.
yeah, super easy way. And obviously, there's a couple other factors, and some people might have some debts that they don't know they have, or their income's a little bit different than what they think. So it's not an exact number, but if you're not going to talk to a mortgage professional, if you just want to kind of figure out what you can afford, that's a good way of doing it.
Great. Okay,
Yep.
so credit, income, and then our debt to income ratio. We got it covered. So in a nutshell, can you run us the basic requirements to get a mortgage?
Yeah, let's make sure we have a 620 credit score or higher. Let's make sure that we have 2 years employment or we've been in college and have an offer letter. And let's make sure, so job history, and then let's make sure we have our debt to income ratio at 50% and make sure that we're not wanting to purchase a house that we can't afford.
50% or lower debt to income ratio.
Right. So that's why in that equation, we cut the number in half, multiply by 0.5, cut it in half, all the same thing.
Gotcha. And where do you see most people falling short on these standards? What are some mistakes to avoid?
Yeah, a lot of people come in, especially first-time home buyers, younger people come in and they don't have credit. They'll submit mortgage application and then on the 3 credit scores box, it'll just show nothing. And I'm like, do you guys have credit scores? Kind of what's going on here? And sure enough, they don't have any credit lines open. They figured credit was just something that follows them. And as they grow older, it gets better. That's not the case. You have to be proactive and go make it happen. Go get those trade lines open by opening up credit cards. If you have a car loan, student loans, whatever it takes, make sure you are building that credit. And that's where I see people fall short more often than not.
I personally really love the Mint app, and I use my bank apps to check my score every once in a while. I go on an Experian. Do you have any other tips for keeping up with your credit? How often should we be checking it? What platforms are good?
Yeah, so I know you get a free credit check every year. So you can basically do a hard pull that's completely free, and it gives you a rundown of absolutely everything credit. Another one, like you said, is just your bank. Bank apps for me, I know BECU, I'm able to see it. And those scores aren't exact. I just applied for a mortgage and did a hard pull, and my score on those apps were about 10 points higher than what it actually was. So take it with a grain of salt. But they're usually fairly accurate and give you a pretty good estimation of where you're at.
Yeah, I think it gives you a good idea of where you're at, and they're pretty accurate about what's on your report between the inquiries, credit lines, and all of that.
Exactly. Yeah. And if you ever have any questions with them, talking to a credit repair specialist, coming to someone like myself or you that, although we're not experts in the field, just we have, some idea of what's going on with it. If people want to send it our way, we're more than happy to give our 2 cents.
Okay, perfect. So that about covers the basics of what you need to get a home, right? That makes it pretty clear. Can you tell us a little bit about the different loan programs you've got?
Yeah, so like I said, we have the 1% down program. It's a brokered out program with a small bank called Luther Burbank. They are using their own money to fund them. They're not backing it by the government, basically. So there isn't that many of those loans to go around. So it's kind of first come, first serve. But it's 1% down. You get 2% forgiveness if you live in the house for 3 years. So basically what that means, whatever the purchase price is, 2% of that you get back. It just comes off of your loan amount if you've lived in the place for 3 years. So that's a super popular program that a lot of first-time home buyers are really liking. You'll only need a 645 credit score with it. 3 trade lines open. So that's kind of what I was talking about earlier. Make sure you have 3. So it's not super hard to qualify for, and obviously has super favorable terms.
That's awesome. And is that only in Washington State?
Yeah, so it's in King, Pierce, and Snohomish counties only. And I know there's a couple counties in California they're rolling it out with as well. But it is very limited and very exclusive. Yes.
Gotcha. Okay. So you and
Yeah.
I are going to do another video on that and we'll cover the
Okay.
1% down in detail. But for
Yeah.
our out-of-staters and when you run out of those, can you explain what else, what other programs are pretty popular?
Yeah. So a conventional loan is our most popular loan product. It's, we can do 30-year fixed, 20-year fixed, 15-year fixed, which basically means the interest rate doesn't change for that many years. So if it's a 30-year fixed, you have the same interest rate for 30 years. And at the end of that 30th year, your loan is going to be completely paid off. For first-time home buyers, you can go as low as 3% down. And if you're not a first-time home buyer, you can go as low as 5% down.
And you have to live in the property.
Yeah, this is for a primary residence, correct. And if you're doing an investment property, you have to put 25% down.
25% down on conventional
Correct.
investments.
Yes.
Okay. And what's the difference between conventional, which you're just talking about, and then an FHA loan?
So an FHA loan is usually a loan we put people in when they can't qualify for a conventional loan. An FHA loan has different regulations as far as credit score needed, credit requirements, how many trade lines you have open, as well as different employment regulations. So they don't necessarily need 2 years employment history. They can work off of 1 year and 6 months. So people that maybe aren't quite as qualified for a home, they likely can get into an FHA program.
Okay. And you said you find yourself doing more conventional than FHA.
Yeah. Yeah. And I think they're definitely more favorable. A lot of people think 3.5% is the least you can put down on a house, and that's an FHA loan, but there is a conventional 3% option as well. And there's this conventional 1% option, and we have down payment assistance options that are 0% down. So if down payment is going to be your struggle as to why you can't get in to buy a home, there's plenty of options that are even lower than that 3.5% down. So make sure to just ask.
Good. Yeah, that's really interesting. And I want to ask you about the down payment assistance. But first, beyond the lending standards of FHA and conventional being different, is there anything after the fact that makes the two loans different?
Yeah, so with FHA, there's mortgage insurance, and there's mortgage insurance for the life of the loan. And what mortgage insurance is you can basically think of it as an extra payment that's anywhere from $100 to $500 per month, depending on what your credit score is. So let's say it's an extra $200 a month. On both loans, you're going to have mortgage insurance, but with the FHA loan, you're going to have mortgage insurance for the whole life of the loan, no matter what. Where with a conventional option, your mortgage insurance will drop off once you achieve 20% equity in the home.
Okay, good. And how do you verify that you hit the 20% mark?
So with Caliber specifically, it'll automatically drop off.
Oh, good.
And we'll also tell you, if you gain 10% equity in your home just naturally, I'll shoot you a call and say, hey, if you refinance now, we can get you out of mortgage insurance and it'll drop your monthly payment by that $200. Get a refinance done in 45 to 60 days, and then you're out of the mortgage insurance.
That's great.
Yeah.
And so you either FHA or conventional or the 1%. Do you pay mortgage insurance on the 1%?
No. So that was one thing I forgot to mention. That 1% program, I don't know how they're doing it. I'm not here to ask, but that is another beauty of it, is that there is no mortgage insurance on the 1% down, even though obviously you don't have 20% equity in the house.
Right. And we'll definitely have a full video on the 1% coming up after this. But FHA and conventional, what I do want to highlight is there is mortgage insurance if you are putting less than 20% down, right?
Yeah. So on conventional, if you put 20% down, you no longer have mortgage insurance, of course. FHA, no matter how much you put down, even if you put 99% down, you're still going to have mortgage insurance.
Right. Okay, good. So that's awesome. Differences between conventional and FHA. Which one do you recommend that we shoot for?
Yeah, so I definitely recommend conventional if you can apply for it, but I think a lot of people might think FHA is scary because there is mortgage insurance for the life of the loan. It's not necessarily scary. You can always refinance out of it. So let's say you don't qualify for conventional, get yourself into an FHA loan. And then when you do qualify for conventional, we can refinance you into a conventional. So it's not doomsday if you can't get into a conventional loan, and FHA is your only option.
Yeah. And Jake, on my channel, we talk a lot about like house hacking and creative investing strategies
Hmm.
when you're young. And you and I should actually do a full house hacking video. But
Yeah.
can you house hack with conventional or FHA?
Yeah, you can definitely do both. So with a conventional loan or an FHA loan, you move into a 3 bedroom and you rent out 2 rooms to friends. And you use whatever rental income you get from them to supplement your mortgage payment. There's no rules against that for either of them.
Yeah. And tell us a little bit because I know that, like, for me personally, I'm working on buying a triplex or a fourplex. And
Yeah,
from what you're saying, I can do conventional or FHA with that, correct?
correct. And now with duplex, triplex, and quadplex, there's going to be different regulations and rules as to what you need to have as far as employment history or credit and things of that nature. But there are options to do both for all those different types of houses.
Sounds like I should be talking to a mortgage professional if I want to start on one of these strategies.
I'd say so. Yes.
Yeah, 100%. And I guess my question is also when I'm doing the house hack, I can use potential rental income towards my qualifying income to do this, right?
Yeah, up to 75%. So if you're going to be getting $1,000 a month for one side of the house, we can use $750 towards your qualifying income. So we'll take whatever you're making monthly, add $750 to that, and then that will be your qualifying income.
Good to know. And how about loan limits across all types?
Yeah, so loan limits have recently changed in 2022. What I'll tell you is for a conforming loan, for a conventional loan, we're up now in King County to $891,250. So to get a jumbo loan, which is loans higher than conventional, you really have to be taking out a ton of money. So most people fall under the conforming category. For that 1% down option, I know the max loan limit is 647,200.
Sorry, one more time.
The max loan limit for the 1% down program is $647,000 or 647,200.
Okay, so 647 is the max of 1%, but you can go up to around 890 on the conventional.
Correct. Yeah,
As of
and then after that we get into jumbo products,
and that's where our
which
lending kind of tightens, right?
yeah, it's where everything sort of tightens. You have to have better credit score. You have to have reserves showing in your bank. You have to have longer employment history, more income showing. So the regulations get quite a bit tighter through jumbo loans. But luckily, our conventional loan limits are so high right now that very rarely are we seeing anything jumbo.
Right. Well, that's good. And that is the loan amount, right? So I can still buy $1 million
Yeah,
house, put 110,000 down, and have an $890,000 standard conventional loan.
exactly. As long as your loan amount is not higher than that 891,250, then you'd be in the conventional loan limit.
Okay, perfect. Well,
Yeah.
awesome. That just about covers everything I wanted to ask you today. Is there anything you'd like to share with the younger audience to help them get started to buy a home?
Yeah, if they know they're not ready to buy a home, that doesn't mean they can't reach out to a mortgage professional, right? Let us put you on the right path to be able to buy a home. So whether that's 2 years down the line, whether that's 2 days down the line, it doesn't really matter to us. Our goal is to help you purchase a home. So shoot us a call, tell us what your situation is. We can give our best 2 cents on how to move forward and get you into a home as quickly as possible.
Great. And you're not a wall in front of the money of cash, right? You're here to help
Exactly.
and advise.
I'm glad you said that. Yeah, a lot of people come to me and think that I'm playing defense against them so they can't get the money. Really, it's the complete opposite way. It's us working together to get you guys approved for a loan. So
That's perfect. Awesome. So where can people find you and which areas do you work?
yeah, so I work all of Washington. As of yesterday, I'm licensed in Oregon. And as of today, I'm licensed in California. And as of tomorrow, I will be licensed in Arizona.
Congrats.
And I'm working, thank you. I'm working on doing it many other places as well. It's not the most fun thing to do to get licensed in other areas, but I'm chugging along, getting through them. So yeah, I'm licensed in those places, planning on getting licensed hopefully everywhere in the country. And we have people in our branch that are licensed in every state in the country. So, you know, if you are in New Jersey and want to have a chat, I'm more than happy to have a chat with you. And then I can connect you with the person in our branch that is licensed in New Jersey as well.
Perfect. Well, thanks so
Yeah.
much, Jake. I will leave Jake's information in the box below. Just hit him up. You're looking to buy a house. He will look at your financial situation and what you can do to start taking these steps to buy a home. And then we can all work together and get you on that path. So thanks so much again, Jake. Thanks for watching this YouTube video, and we'll see you in the next one.